Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our speaker and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. This is one in a series for young professionals about understanding some of the basic financial concepts. And we're excited to talk about understanding debt today. Attendees are muted, but we encourage you to ask questions using the chat box. And I'm not sure if we talked about this yet, Kate. Is it okay if I interject and we talk about things if people have questions during the presentation?
Absolutely.
Okay, great. Just wanted to make sure. So if we don't have time to answer your question, make sure to leave your number in the chat box as well, and we will have someone reach out to you if we don't have a chance to answer it during the presentation today. We want this experience to be as educational as possible. Please don't hesitate to ask for clarification or expansion of the material. Well, I'd like to introduce you to today's presenter, and I'll put your picture up here, Cade. Cade Hammes is the owner of Storybook Financial in Coralville, Iowa. He is a certified financial planner with degrees in accounting and finance from Iowa State University. Leading up to founding Storybook Financial, Cade gained great experience working on financial plans with pre-retirees and successful business owners. He and his wife are the parents of one daughter who has cystic fibrosis. And I'm so excited to have you present today again, Cade. So I'm going to go ahead and stop my screen share and go ahead and let you take it away.
Okay. Well, welcome everyone. Bear with me as I look for my proper screen to share here. As she said, today is all about understanding debt and really from the lens of young professionals. I do think it's relevant to pretty much anybody hoping to understand debt a little bit, but I very much work with young professionals with my firm. I just kind of set it up a little bit different than the standard advisory firm where it seems like how much money they can manage is all that's important. And for my mindset, that just ignores the other people out there like myself and my wife, because we haven't had a chance to save up that much yet. And so a lot of what I'm seeing with the young professionals are, we want to know about not just retirement, but we want to know about other things. We want to know about how do we pay off our student loans? It's becoming quite the crisis in our country, and it's becoming a very important thing to understand. We want to know about, we might have credit card debt because nobody kind of told us as we were growing up how credit cards work, and now I feel buried. How much home can I afford? Should I buy or rent? Things like that are just conversations that I'm having a lot with my young professional clients. And so that's what today's about a little bit is trying to understand that and making sure you get off on the right foot. The first slide here is what is a loan? And I'm sure you all know what a loan is and what debt is. And my mindset as a financial planner, it's really you enjoying your life today with money that isn't yours yet. It's you're creating an obligation to pay for something that you're enjoying today. So if you think of it from, she's holding up keys to, I'm assuming a house there, it's got a house connected to it. By you taking out a mortgage, that allows you to buy a house, your home, that you can't afford to pay in full today. And so it creates an obligation that you are agreed to pay back, not just the amount of the house worth, but you're going to pay the bank or whoever is lending to you the interest. That's the cost of the loan, the interest to them, so that you can enjoy it today. And in some cases, like your home, that's usually not a big deal. But in cases like a credit card, when we're buying more short-term things that we just can't afford today, it can become a very big deal just because of the high interest rates that are associated with those things. So what are the different types of debt? I've broken them up into two here, and the second is on the other page, is secured and unsecured loans. I started with secured because they're a little bit easier to explain, and that is any debt that has collateral. So if you remember when you were a young child in school and you wanted to go somewhere and the teacher said, I need collateral, and they make you fork over your pen or your pencil until you get back. It's kind of the same thing. So when you take out a mortgage on your house, you're essentially using your house as collateral. The bank is requiring that you basically give them the rights to your house. If you quit paying on your mortgage, they have rights to essentially take your house from you. Same thing with an auto loan. Your auto directly secures that debt. And so it gives the bank the right, if you don't pay, to take that from you. So that sounds like it's probably really bad news. You don't want to have to fork over collateral like that. But in the case of these, is what it does is it allows the bank to understand there's a little bit less risk there to the bank. And so the banks will give you a much less of interest rate. So the cost of the loan is going to be quite a bit less. And I started with kind of the lowest interest rate that you're probably going to see is going to be a mortgage. It's your house because it's very well secured for the bank. Auto loans, because autos just appreciate in value so quickly, those are just a little bit less secured in the eyes of a bank. And so the interest rate's going to be a little bit higher. Home equity, that third one there that you see it's kind of like a mortgage, but it's going to be a second mortgage. It's coming in on top of your mortgage. So if you say you do a down payment of 20% and you owe 80% of your house to the mortgage, you can do a home equity loan, usually up to 90%, and you can take out a little bit more. And usually home equity loans are used for things like, you want to remodel the kitchen, or you want to remodel some part of your house, or you want to upgrade. That's where the banks, they understand what you're hoping to do. And so you can take out that shorter term loan for a little bit higher interest rate and be able to do that. I'll talk about it a little bit later when we talk about refinancing and things. Home equity loans, home equity line of credits kind of work like very large credit cards. And it's a very good place if you have equity in your house available, that if you go to refinance something like a credit card, that's a very good place to do it because you can get the interest rates cut by so much. I also have the word tax just because I wanted to mention it very briefly. Not as much today just because of the change in tax rules in 2017, but mortgages usually come with a tax benefit, which is on your Schedule A of your tax return. You can essentially try to get that deduction for your mortgage a little bit higher. The issue with the 2017 tax return is they basically doubled the standard deduction, the deduction that everybody automatically gets. The Schedule A, and I'm trying not to make this overly complicated, Schedule A lets you itemize your deductions. That includes healthcare cost, mortgage cost. That's where your charitable contributions go. If you get those, if you have really high costs as it relates to those things, you might be taking the itemized deductions instead of the standard deduction. But like I said, it was a lot easier to get about 3-4 years ago before the tax changes, just because they doubled that standard deduction. I just wanted to point out that mortgages do still have that kind of hidden benefit that the other loans don't have.
Can you talk really quickly before you move on? Can you talk really quickly about what an interest rate is?
Yeah, so an interest rate is, like I tried to allude to, is just, it's essentially what you are paying the bank to give you the loan. And so as you pay back any loan, you're going to be paying back two pieces. You're going to be paying back the principal, which is just the value of, say it's on your house, the principal of your mortgage is you paying the value of your home. The interest rate is above and beyond that, because that is what you are paying the bank. That is the fee that they're collecting for giving you that loan. And so it's the same thing with the student loans. As you pay back the principal, you're paying back everything that you spend on principal or everything you paid to be able to, the tuition, the loans for the books. The interest rate is what you are paying the servicer of the loan for giving you that loan ahead of time.
And I
Hope
know
that
it's,
answers it.
yeah, and I think what I have another kind of sub question here. So what can you give an example? So like on $1,000, if you borrow $1,000 and the interest rate is, I don't know what percentage you would throw out there. Essentially, how much are you paying back to your to the organization that gave you that loan?
So just really crude math, if you borrow, say 10,000, I'm going to try to keep the numbers really easy, and you say it's a 10% interest rate, just trying to keep it really easy, you're paying $1,000 a year in interest to that person. And so it's costing you $1,000 a year with a 10% interest rate. So if you have a 5% interest rate, it's costing you $500 a year for that same $10,000 loan. And so that's why the interest rate becomes important, because it's very much how much you're paying the bank or whoever gave you that loan for having that loan. That's why it's very important to pay attention to what is a high interest rate, what is a low interest rate. I tried to put them somewhat in order, and I know I have student loans and credit cards. These are generally unsecured loans, which means there is no collateral for the bank to come after. If you think about a student loan, you're a young person that has not, you haven't had the ability yet. You're fresh out of high school. You haven't really saved up money to be able to afford college. You don't have any other assets for them to tack onto. So basically what a student loan is, the bank is saying, you know what, we know that by you going to college, you're making your time more valuable in the future. So we're willing to give you the loan today, knowing that you have the ability to pay it back after you graduate, because we know your income is going to be a lot higher after you graduate. So we're willing to take that risk. Most student loans, and I've seen them vary quite a bit, but I've seen them as high as 7%, which is, it's not a very good interest rate at all. It's rather high interest rate. I've seen them lower than that, depending on the credit and the style of loan. And then the last one I've really listed on there are the credit cards. And credit cards are kind of that short-term line of credit. They're always there, and we always want to utilize them and try to get the bonus points and the rewards. And the key to credit cards is if you don't already have kind of the debt taken out, if you haven't built up a massive balance on credit cards, it's to just pay them off in full every month. If you pay them off in full, you're never going to be charged that interest rate, because they don't charge it until after that month has passed. And so that's kind of the key. So if you do that, you can earn rewards. You can be the person that earns rewards and kind of get some money back for using the credit cards. The big caution there is you want to make sure, if you're somebody that's going after rewards, that you make sure you always get paid in full. The first time you forget, they ding you with quite a few fees for missing the payment. And then the interest rate is so high on them that it quickly removes any rewards you've gotten throughout the year. And so that's why credit cards can be very dangerous. I'm one of the advisors. I don't hate credit cards. I'm not going to ever tell anybody they need to cut them up unless they officially have a problem. And debt can be something that is a problem. You can have a spending issue that we might need to learn to hate debt. We might have to cut up credit cards, but I don't hate credit cards. They can be a very valuable tool and something that you can utilize. But on the flip side, let's talk about somebody that already has credit card debt. Those balances are already built up. Credit cards generally are in that 20% interest rate range. So that same $10,000 we talked about, if it was 5%, you only get charged $500 throughout the year. 20%, you're getting charged $2,000 throughout the year, just because you took that credit card out. So that's why it's just so important to keep on top of specifically credit cards. And I'll talk about it a little bit more here in a second. The last little cautionary note that I have here is just a note on co-signing, and we didn't know where to throw it on the slides. Is if you're ever approached by somebody asking you to co-sign on a loan for them because they cannot get the loan themselves, it's chances are it's probably somebody that you know very well and somebody that you very much love and are related to. But I do urge a lot of caution to that, because if the bank is not loaning to them directly, that there is a reason. They are struggling themselves in some fashion, and that means the bank has essentially said that they're a risk to not repay it. By you co-signing, that essentially puts you at risk, because if that person can't pay it, the bank will come to you and say, you need to pay this because you co-signed. And so I have co-signed myself in the past, but it was very much a case where the person was able to show me where they had money coming to pay it all off in full within just a few months. And so I knew where the money was coming from, and I had full confidence that it was going to be repaid, and I wasn't going to be on the hook for it. But it's just use caution. I'm not telling you don't do it. I just want you to know what you're signing up for if you do something like that. And as I was talking about caution, I also thought of something else with credit cards that I've seen from time to time, and that's people will do the trick. You see the credit cards will offer the 0% interest rates, introductory rates, and I've seen people, they have a credit card balance and they just keep moving it to the new credit card that has 0% interest. If you can do it, that's great, and it's a pretty cool way to kind of always keep that 0% interest, but use a lot of caution with that, because what they do is at the end of the 6 months, a lot of times, if you miss that payment, they don't just get you for this month's interest, they'll get you for the full amount of time that you've been doing 0%. So if you've had 0% for 12 months, they will get you for a full year of interest payments. And so it's just something that I just want to put caution to the wind. If you try to do that, credit cards are just not something that you want to play a lot of games with. So kind of the big elephant a lot of people wonder about debt is how much is too much debt. Hopefully, if you're not in debt, we can try to find ways that we don't need to go in debt. As I know I'm talking to the young professionals, but as you're getting close to retirement, being in retirement with debt is not an ideal scenario. So it's really good if we can kind of avoid that. But we're young, and you know, there's things like a house that we want to be able to buy, and you know, we have student loans, and that's part of life, and sometimes you have to do those things to be able to move on. I believe student loans are a wonderful way. They're a wonderful tool. If you cannot afford college, that really can make a huge difference in your life, is getting that college degree. And so taking out a student loan is perfectly okay. Taking out a home mortgage is perfectly okay. That allows you to live in a house that you might not be able to afford for years. So the big question is how much debt is too much debt? And I threw up 3 kind of ratios that are utilized in the financial industry. The first one is the consumer debt ratio. So this is really just includes any debt outside of your home. So that's going to be student loans, auto loans, credit cards, whatever it is. What we do is we take your net income, so your take home pay after the taxes are removed, and we essentially divide it by the cost of your debt. And so anything above 20% is basically saying that you're using 1/5 of your income for these things that are really not ideal. And so 20%, if you get above that, that's you're really going to be hurting to pay those things off. A lot of things can vary here, because you also have a house mortgage as well, right? If you don't have a house, if you're renting, it might not be as big of a deal than if you do have a house and you're also renting. But that 20% is usually the cutoff. And I want to stress here that all of these numbers on this page are kind of the upper limit. Like if you're over them, it's really bad. Even getting close to them is not good. So the consumer debt ratio, if you can keep it below 15, below 10%, especially below 10%, I think you're probably doing pretty well. If you're getting over 20, if you're getting up into the 30s, that needs to be a huge focus for you, is trying to get rid of some of that debt and trying to make sure that it's not a huge burden on your finances, on your income. The housing cost ratio, it's going to look at just the cost of your housing. So you can do this with rent. Chances are that the rent could be cheaper than this, but what you do is you add up those 2 things we already talked about: the principal, the part that you have to pay each month for the house, the interest, which is usually included in the same payment, but that's the part you're paying to the bank, But then we also ask that you include taxes and insurance, because those are things that come with owning a house, and they're things that we know very much. And so the banks usually will lend you 20% of your gross, 28% of your gross income for your house. That includes taxes and insurance. And those things, oftentimes taxes and insurance are often included in an escrow, which means you're paying the bank extra so that they take care of the taxes and the insurance for you. A lot of banks, unless you're borrowing very little and have a great credit score, will force you to do an escrow because they want to make sure that they're getting paid, that the government's not going to take the house, in which case then they don't have something that they can come after. So that's why they often want to be the ones to pay that. Escrows can be a nice thing anyway, just because they break up that tax payment into monthly payments that you don't have to think about, versus twice a year you have to come up with this large amount for taxes. What the housing cost ratio doesn't include, that I always want to tell people that are thinking of buying a home versus renting, is it doesn't include house repairs. When you switch to owning versus renting, generally the repairs are on you, not on a landlord. And those can be very costly. So if you're thinking about buying a house, I just want you to kind of include that in your thought process, that, you know, there's also costs going into maintaining the home and keeping it running. And I have, I think, 3 or 4 sinks in my house, and it seems like one is always leaking at some point. We just have hard water in my town, and we're just constantly fixing sinks, it seems like. So
You
again,
need a sinking fund for your sinks.
yes, exactly. So anyway, the 28%, that's kind of the upper limit. That is what the banks are comfortable lending up to. That doesn't mean you should automatically go look at houses at 28% of your gross income. That actually could be a little bit high if you could go.
You mean like a house payment that would be 28% of your gross, correct?
Yep, house payment including taxes and income.
Okay.
And they use gross on the last 2 ratios. To be honest, I don't know that there's a whole lot of reason why they use net on the first one or gross on the bottom 2. It's just the way they did it. In my mind, it makes more sense to think about it from a net standpoint always, but you could go a little bit higher if it was from a net standpoint. The reason I like using net is just because that's your take home. That's what the money you actually have, versus gross is not a fictitious number, but it's money you don't ever see, because that means there's money coming out for tax yet. And then the bottom ratio, usually the 28 and 36 numbers go together. One's called the front end ratio and one's called the back end ratio. That's not overly important to understand, but if you look up after we're done, if you want to know more, you can look up the 28-36 rule, and then we'll talk a lot more about it. But the 36 rule is total debt. So now you're looking at all of the house cost and all the consumer debt cost. And we're adding it up, and we're saying it should only be 36%. And so if you add up, and I know one's net and one's gross, but if you add up the 20% on the consumer debt and the 28% on the housing debt, obviously that's much higher than 36%. And so they're saying, don't add both of those 2 amounts, because if you have one, it affects the other. And so your total debt, you don't want your burden to be much over 1/3 of your income, because it can feel very stressful at times. If anything's going on, your ability to pay that back. And then that very much becomes important. And I think what I want to stress here is, you know, people talk about bankruptcy a lot, and what causes bankruptcy. It's usually not that you are totally broke, that you have no net worth, that your net worth is below 0 and you're floating. What it is usually it's more of a cash flow problem. It's your income is not enough to meet your expenses. If you don't have any debt, chances are your income is very adequate to meet your expenses. Your ability to live, I mean, if you had to, you could live off of ramen noodle for a little while and survive with cutting some expenses. But when it comes to the debts, those are things that you're going to be forced to pay, because the bank's going to just keep knocking on your door until you do. So that's where you can get in trouble, and bankruptcy gets declared. It's really more around the cash flow scenarios, and debt is what can really start to hinder if you take too much at once. Young professionals prior to having children, I think can get in a lot of trouble here because they'll take out the debt while I call them the dinks, the double income, no kids. We have all this money and not very many expenses. And so we can afford this huge house. And so we go buy this huge house and get this obligation for 30 years. And then we start having kids to fill the house. And now all of a sudden we can't afford both the kids in the house. And it's just a really weird scenario, but it is a very real scenario where you have a lot more income while you're young.
Mhm. We did have a question come in. If you have other debt, does the bank look at that when getting a home loan?
Absolutely. The bank's going to want to look at I actually worked at a bank for a while. I'm more on the commercial side than the mortgage side, but I was a commercial credit analyst. And so I was looking at businesses, but we weren't just looking at the business's financials. We were looking at the business owner's financial, the person that was taking out the loan. And so what we wanted to know is, what are their assets? Where are their assets? As in, do they have a house? Do they have retirements are really hard for bank, like an IRA, as those are harder for the bank to go after. But if you have a brokerage account, investment account, those are something that the bank looks at because that gives you a higher ability to pay. If you have a lot of cash, if you're sitting on 6 months cash reserve, that makes you more somebody that they can lend to a little bit better. If you don't have a lot of other debts, they know that you don't have all these debts, they can look at it. And so that's the total debt ratio and the housing cost. When you're doing a mortgage, they're going to look at both of those. They're going to look at your total debt to make sure that if you have a consumer debt ratio of 20% net, chances are you're not going to get to go up to that 28% on your gross house. They're going to limit you to that 36% on the total debt ratio. And so absolutely they will look at all of that. And those usually come up in the credit reports. You don't even have to tell them about it when they go to pull your credit report. Some banks don't even pull a score anymore. They're just looking at the report to see what you have. And that's where they're going to go in and add those things and try to understand what your cash flow burden is. Income is very important when you're taking out a mortgage. They're very much going to look at they're going to want like your W-2s and see how much money you're earning or your pay stubs. Two incomes, it's going to be a lot easier to lend to than one income. One solid income is going to be a lot better to lend to than somebody that's, we kind of have the gig economy, somebody in the gig economy that has a lot of income one day and then not a lot of income the next day. That's quite a bit bigger risk because can you afford to pay on those days where you don't have income? And so the banks are going to want to see things like that.
And
So
I just wanted to say to our attendees, go ahead and throw in some more questions and I'm happy to ask them as we go along. Great question, by the way. Thank you.
Yeah, absolutely. And so this page, I really want to try to answer, how much home can I afford? And I just want to give you a couple ways to look at it, or at least a couple common ways I see looked at it. The 28-36% rule, we've kind of just discussed at length. Another very common way that I hear people reference all the time is the Dave Ramsey way, and I'm going to put those in quotes. Dave Ramsey, if you don't know much about him, he's a guy that he's just made a whole career out of basic personal finance, particularly related around people trying to get out of debt. I do believe his program for getting out of debt is really good, and a lot of his rules are very good. I don't do things exactly the way he does them. I custom everything to the specific person. And we'll talk a little bit more about some of his baby steps on another slide. But when it comes to buying a house, he has a very clearly defined rule. He recommends 25% on a 15-year mortgage. So that's quite a bit different. And so he's doing that 28% rule, but he's saying only 25% and then on a 15-year mortgage. And that is actually quite a drastic difference. And a lot of people's complaint with this, I live in Iowa, and so cost here, we very much could follow the Dave Ramsey rule if we wanted and minimize how much debt we're actually taking out. After 15 years, you have the mortgage paid off and you're sitting very pretty. Somebody that I have quite a few clients in New York and California, and I can tell you will struggle to afford a house on his rule, just because the cost of living is just so much higher. Houses are so much higher. It's just a very hard rule to follow if you're out there. And so what I wanted to do is I've made a very crude Excel to kind of compare 15-year mortgages to 30. And I just wanted to, a lot of people have that question, 15-year versus 30. So I just wanted to share this, and hopefully you can see it. Marche, if you can give me a thumbs up.
Yeah, we can see it. And then just kind of describe it as we go along. That way people can follow along if they're watching on a smaller screen.
Yep. So I have a column for a 15-year mortgage and a column for a 30. And for this purpose, I just decided that I went with a relatively cheap house. You probably won't see a house this cheap in California or New York. This is even cheap for the Iowa side. I just wanted something very quick and easy. A mortgage of 80%. So we have a $200,000 mortgage. I used Bankrate to find the most current rates as of last night. So 30-year mortgage, 3.16%. 15-year mortgages usually come a little bit cheaper because you're paying it off quite a bit faster.
Okay, I'm just gonna go back for those of you who may not be able to see it as well. So the house itself costs $250,000, and the mortgage, the loan is $200,000. So there was a $50,000 down payment, correct?
Yep, $50,000 down payment.
Okay, keep going.
Yep, and so I calculated the annual payments for each of these. And so the 15-year mortgage, remember, you're paying it off twice as fast. Even though you have a cheaper interest rate, your cost of the loan is cheaper. You're paying the principal part, the value of the house off twice as fast. And so your payment comes out to be just under $16,000 a year. And I know you pay them monthly, but for simplicity, I did this annually. But this is around what your payments would be throughout the year. The 30-year is a little bit cheaper at a 10% or $10,000, 300 annual payment. What I did was I wanted to kind of compare the two, because people want to compare these all the time. So I just tried to pretend, you know what, any excess. So here's how much excess you have to pay on the 15-year. So in theory, you have about $5,600 a year. If you take out the 30-year mortgage instead of the 15, you have that much money that you could save each and every year, because you have that much more cash flow, because your cash flow is quite a bit smaller with the 30-year. And so what I did was I just came up with a really somewhat safe 6% return, and just said, what if we get a 6% return on that money if we save it each and every year? And so the 30-year, we start saving that. And each year you get to save it again. And each year it makes 6%. And so you can see that balance gets up to about 130,000 by year 15. A 15-year mortgage, in year 16, all of a sudden, you don't have a payment anymore. You don't have your mortgage anymore. It's gone. You've paid it off. And so now you can start saving the full amount of your payment. And so what I did was I just started saving that at 6% each and every year. Meanwhile, the 30, I still have saving that same 5,600 each and every year. And what I really wanted to illustrate here is at the end of 30 years. So when the 30-year officially pays off, you actually have more money with the 30-year than you do with the 15. That is not always the case. And I want to stress that. It really depends on what your two interest rates are. Lately, interest rates have been so compressed. They've come down so far to record lows throughout the last 5-10 years. That they're so similar, the two rates, that the 30, to me, a 30 makes sense because it keeps your cash flows low. That gives you kind of flexibility with your cash flow, especially as a young person. And then at the end of the 30 years, if you save it, and that's a big if you save it, you can come out ahead with the 30. Now, the bonus is if you don't save it, you have that extra $5,000 a year that you could be spending. If you go the 15-year, obviously after 15 years, you have the ability here. And so from my mindset, should you choose a 15 or a 30? It kind of depends on where you are in life and how much cash flow you have. If you are somebody, if you are, in your 50s already, you already have quite a bit of money, you're just buying a different house, you're selling your current house, buying a new one, you're going to have a huge down payment. And so you can afford to pay it on a 15 all day long, pay it on a 15, get it gone by retirement. But if you are a young person and you and your spouse are in your 30s and your cash flow is tight, you're trying to afford your children and pay off student loans and all these things, your cash flow is very tight. I very much think a 30-year probably makes more sense for you because it keeps your cash flow so much smaller. Obviously, it's going to cost you a little bit more, but not enough to make a huge difference. And so I usually tell my young clients that 30 years is okay. And if you are a Dave Ramsey fan and hate that advice, that's okay. I get clients now and then that they hate debt. They've listened to Dave Ramsey, they hate debt, and so we follow Dave Ramsey a little bit closer. That's something cool about financial plans. They're custom tailored to you, that if you hate debt, that we can go that route. And any advisor you go to is probably going to give you that same advice. So I'm going to jump back to my slides quick. I think I seen a red dot come up. I don't know if that was a question on that.
There was a question, but I asked if they would give me a little more information. So I'll bring it up when we have a little more information.
Okay. How much home can I afford? The one caution I wanted to give here is variable interest rates. Right now, interest rates are kind of at their extreme low. In the last probably 30 years, if you did a variable interest rate mortgage, you probably were okay because interest rates have been going down for 30 to 50 years now, for the most part. The problem with variable rate mortgages is if interest rates go back up, your payment is going to go up with it. The cost of the mortgage is going to go up with it. They're currently kind of at all-time lows. So a variable interest rate right now is going to be a little bit cheaper than the fixed rate. But by the time you get your house paid off, it very much could be double, triple, quadruple what your current payment would be if you stick to the fixed payment. So almost always I'm going to tell you, go with the fixed payment, lock it in for the next how many years. The only time I would ever really recommend a variable is if interest rates were already extraordinarily high and you knew that it would come down with that. But even then, you're probably better to lock a rate in and refinance in the future. Refinancing, and I'll try to say it very briefly, refinancing can be really good if interest rates have come down a lot. The catcher to refinances are they usually charge you origination fees, which means they're going to charge you $1,000, $2,000 to be able to take out a new loan. That's kind of the reason banks are willing to refinance. So you're really only going to do it if you really need to get your payment lower, or if it's such a substantial interest rate difference that it just makes sense for you to do so. Any other thoughts on that, Marche? Or
I had just had a question. Can you talk a little bit about refinancing? And then you already answered it. So there we go.
It's like clockwork. So pay down method is something that usually I almost always get this when I see debt is, usually we have a lot of different debts, different types of debt, different interest rates. The clients coming to me, I see quite a few different things. I just seen the picture in the background. We might have taken out a personal loan to pay for a wedding. I see the rings. We might have taken out a small personal loan to travel. I don't know that I would ever take out a loan to travel personally, but if you had to have that trip, you have money coming later in the year, it can be an okay thing. The mortgage, it might be you have student loans, and student loans, if you've seen them, if you have them, it's not one big loan. Usually it's probably, if you've went to 4 years of school, you could have somewhere like 8, 10 loans because you got one each semester. And all of them have different interest rates and slightly different names to them. Some might be direct, some might be subsidized, just different things going on. And so how do you choose which one to pay down first? And there's really two schools of thoughts. And again, I said we would talk about Dave Ramsey. He's very much kind of at the forefront of the consumer world and paying down debt. And so he created something that he calls the debt snowball. He is very much interested in helping people that have been underwater for quite a while. He's very much interested in people that they kind of have that debt problem and they need help making it go away. And so the debt snowball focuses on what is the smallest balance. And so what I mean by balance is, if you owe $10,000 on a credit card, $5,000 on a student loan, the student loan has the smaller balance, you would pay on it first and make it go away. And there's kind of a psychology to that because, you get to watch that loan go away and it gets you excited. But where the snowball effect comes in is now all of a sudden, all the money that you were being forced to pay towards that smaller loan, you have the money that you used to pay it off and the money that was being forced to pay it available to pay on something else. And that's the key piece to what he's saying is until the debt's gone, that's going to be your focus, is using all of that money that you get paid off. Every time you free up cash flow, it's focus on the next one, then focus on the next one. And it looks a little bit like a snowball rolling down the hill. It might start out like a small thing, but then as it rolls down the hill, it's a pretty big, powerful ball that you have going for paying off the last more. Usually it's your mortgage that's last because it's the biggest balance. And I think his baby steps, he actually usually has you, he doesn't hate mortgages as much as he does all the other loans. So he has you pay, like he might have you getting your savings up before you start paying on the mortgage. I believe he goes with the standard 15%. I can address a little bit more about that in a second, but.
I just wanted to interject here that you would be paying minimums on all your other debts.
Yes. That is a key point is all of your debts, once you start paying them and come up with a plan to pay them, you're always paying the minimum payment on each of the debts. And the reason is you want to avoid penalty and you want to avoid if they have collateral on that debt, say it's your auto, you don't want to just quit paying on your auto, they'll take your auto. And so you want to make sure you're paying at least the minimum. And with credit cards, that can sound very different than what I told you earlier. If you have the ability to pay credit cards in full, always do that. But if it's so much debt on the credit card right now that you can't pay it in full, we're going to want to very target which we're going to want to pay one loan at a time. And that's true in either the debt snowball or the debt avalanche that I talk about below. You always want to pay the minimum. You always want to make sure that you're not getting dinged penalties on top of the interest rates. But we're going to very much focus on one at a time and get it gone.
Maybe I can just interject here. So you're saying that you want to pay the minimums, and then for the debt snowball, the one that is the lowest balance, you throw extra money on top of the minimum on that smallest balance one. Is that correct?
Yeah. So I guess an example, say you have the auto loan, a student loan, and a credit card, and you've been paying like $50 a month extra on each of them, beyond the minimum payments for each of them. That's not how we usually do it. Is what we do is we take them all down to the minimum, and now you have $150 a month to pay towards one, the most important one. The debt snowball, the most important one is the one with the smallest balance. The debt avalanche, which is kind of the financial planner world, has created that name playing off of Dave Ramsey's snowball name, is because a lot of them disagree with what he's saying. They're saying, no, you should pay on the one with the highest interest rate. You should pay on the highest interest rate because it is the one that is costing you the most money. Even though it might take you longer to get that one paid off, it's better to make that high interest rate go away. I kind of take an interesting approach with my clients where, custom plans for each individual. So we're going to look at all of them and try to decide. And what's really funny about it is it's really kind of splitting hairs anyway, because usually your smallest debts are the ones with the highest interest rate. It's just kind of the way it works out. Usually your mortgage is your largest, which has the lowest interest rate. Usually your cars have the next lowest. They usually are the next highest. Student loans, like I said, it's not like you took out one big student loan. It's going to be a lot of smaller loans. And so that's why it's just a little bit different. I'm going to pull over another Excel, and I'm sorry that these Excels are very crude looking, but I just wanted to kind of illustrate the difference between the debt snowball and the debt avalanche. So at the top here is kind of explaining you have two different loans. Loan A, you owe $20,000 with a 20% interest rate. Loan B, you owe $5,000 with a 6% interest rate. The total amount that you owe is $25,000. I could have gave you an average, but I don't think that really matters. So what I really want to illustrate is I created a minimum payment. I just said if we're paying it off over 10 years, what would the minimum payment be? And so loan A is costing us quite a bit more. It's It's 4,600 versus only 600 for this $5,000 loan. So the cash flow, the amount coming out of your cash flow each and every year is quite a bit more. The interest cost is also quite a bit more. All this is to get this number, you just take that 20,000 times the 20%. That's how I got 4,000. The 300 is 6% of 5,000. And so your interest rate cost on this one is quite a bit more. It's also a bigger loan. So I want you to pretend for a second that you have $5,000. I don't know if this is money that, like in Monopoly, you play community chest and all of a sudden there's a bank area, you got 5,000. I don't know where this 5,000, maybe you had just had it saved, but we have 5,000 to play with.
Maybe you got a second job, a gig job to pay extra on your debt.
Yep. Whatever it is you want, there's an extra $5,000. Where do we put it? The debt snowball tells us the smaller balance is loan B. So let's pay on loan B. Well, it just so happens that we can pay loan B off entirely. And so that made that loan go away. This loan is still sitting at the exact same amount that it was before. And so now your new balance, you paid $5,000. Now instead of 25, you owe 20. Your new minimum payment instead of 5,300 is 4,600. And your interest cost is just the 4,000 from the one loan. Alternatively, the debt avalanche is going to look at this high interest rate and say, let's pay on that high interest rate. So we leave this loan completely intact and we pay it over here. So we still owe 15,000 on this loan, on loan A. But it very noticeably, it did not change the minimum payment. A credit card, that might not be true. And I know I put 20% like it was a credit card. A credit card is interesting because they're going to base your payment off of the current balance. So as you pay on it, the minimum requirement is probably going to come down. But if it's more of a fixed rate loan, for this purposes, I wanted to illustrate the fixed payment loan. Your payment's going to stay the same until you pay it off. And so up here, you were able to pay it off, so that payment went away. But here, the payment stayed the same because we weren't able to pay it off. But what did happen is the interest rate came down. So now you're only being charged 20% on 15,000 instead of being charged 20% on 20,000. So you owe $1,000 less a year. You still have this one, but what I really want to come over to is you still owe the same in both scenarios. You still owe 20,000. The debt snowball helped out your cash flow. And so 4,600 versus 5,300. So if your goal is to free up cash flow, if you're really struggling with your cash flow, you cannot make ends meet month to month because of the debts that you've acquired, the debt snowball can make a lot of sense because it helps free up cash flow and helps give you that security. But if you can make the payments and you're more interested in what they're costing you, the debt avalanche makes more sense because it's costing you now $700 less than what the debt snowball would have done. And so it makes the true cost of the loan decrease. And that's why so many financial planners really want people to go this route. Honestly, it's very much kind of individualistic and looking at each one. And I've seen this from time to time where we have, I'll use the student loans as the example. We might have a 7% interest rate student loan and a 6.8% rate student loan. The 7% has a huge balance of like 35,000 because we were able, we went to grad school and we were able to put the whole year on it all at once. And so that 7% loan is a really large loan. 6.8, it was just one semester in undergrad. And so I only borrowed 5,000. That 5,000 is going to be a lot easier to pay off than that 35,000. And it's such a similar interest rate that almost always I'm going to tell people to pay off on a smaller balance first, just because the interest rates are so similar. They're almost costing you the same, free up the cash flow and help put yourself in a little bit better position. But if the two balances are close to equal, you're going to pay on the highest interest rate because that's what's costing you money. And I don't know, Marcia, if there's any questions about the difference in the two right here.
I don't think so. I will tell people that we are going to probably keep going a little longer than we usually do. We usually do an hour, but we want to make sure to answer your questions. So remember that there will be a replay emailed to you, a link to the replay. I don't want to rush, Kate. This is such great information. So I do have a question about leveraging debt, but that is maybe something that I know we're going to address at the end. So I wanted to take that question at the end.
Yep. And I will, if I can see places to speed up, I will. Student loans, I do want to spend a little bit of time on. Student loans come with a lot of different rules and things that you can do to help pay them off. The government does have quite a few things that they've done to try to help out. Some can be good and some not so good. A couple really weird rules that I want to point out is student loans are non-bankruptable. That means if you're somebody, you're so swamped with debt, if the majority of it is student loans, you really cannot use bankruptcy to make the student loan go away. It's just one of the rules that they have with them. But alternatively, when it comes to spouses, if you get married, one reason why you would consider not refinancing is if something happens to the student with that loan is going to go away. The spouse is not required to pay it. Now, if you come into your marriage with an auto loan, the auto is probably going to your spouse, so is the debt. And so they're going to be responsible to pay that.
Okay, I just want to pause you here. So in case someone dies and they're married, that student loan that obligation does not get transferred to the spouse, correct?
Correct.
Okay.
Just one of those kind of neat, cool kind of rules. Student loans usually have some pretty neat rules about them that make them preferable. And we'll get down to the biggest one, which is loan forgiveness and the potential for it. And so that's why it is, depending on the interest rate and the balance and what other debts you have, student loans might be one of the last ones that we look at that paying off. It just depends on if it's those 7% interest rates and all of your other loans are down around 5, 4, 3%. Then we would obviously start looking at the student loans first. It just depends. So the standard repayment plan is a 10-year timeline. So when you start paying on your loans, usually 6 months after you graduate, you're going to be paying it over a 10-year timeline. So that's how they designed it. That is the way that it gets paid. Income-based plans are different. There's quite a few different income-based plans. They have different rules about who qualifies for them, what percentage of your income they use. Some are as low as 10% of your income. Some are as high as 20%. The 10% are a little bit harder to qualify for. It's really dependent on you. The key thing that I want to allude to here is the interest rate is not going to change. All you're doing is delaying how long you have to pay it off. So it might make it 15, 20, 25 years, I think, with the case of grad loans to pay off the student loans if you use income-based repayment plans. They do that if you absolutely are struggling to pay for your student loan. So there kind of has to be a need for you to jump over there. And I recommend, unless you have a strong need to switch to an income-based plan, that you stick to the 10-year timeline, because you don't want it costing you that much over that long of period of time. The one scenario where we would purposely switch to an income-based plan, even if we don't have that strong need to, would be in the case of loan forgiveness. Loan forgiveness, and one of the kind of big ones that are out there that people will talk about is called public service loan forgiveness. I think it happened in the George Bush era of the government. They came out right at the end of his term and said, you know what, if you commit to serving in the public service field, like you're doing a nonprofit service or you're working for the government. And I work with a lot of healthcare individuals, so it's very common to see them qualify for the loan forgiveness. That's something that you want to go after. Well, you have to make 120 consecutive payments to qualify. So that's 10 years. Well, if you're on a 10-year timeline, it's going to be repaid already anyway. There's nothing to forgive. And so it also has to go in conjunction with switching to an income-based plan where what you're paying is lower than the 10-year timeline. And I'm sorry if that got confusing. It is kind of a confusing rule, but I don't want to go too in depth since we're getting close on time here. Loan forgiveness, you want to make sure that you qualify. You want to make sure that you are following all the rules. The first year of of the loan forgiveness that people were able to actually go request the loans be forgiven, it had a 99% rejection rate. I don't want to scare you, but it's people just didn't understand what types of loans they had. They didn't understand the type of employment. And it was a big problem. And luckily the government has started to fix that. I believe if you're just starting the 10-year timeline, it should be much better by the time we get there. I'm doing this with a couple of my clients, and what we do is we're certifying their income as qualifying each and every year. And we're making sure that they're in an income-based plan and that they're going to qualify when they're done. There's a few things that you can do now that you couldn't do back then to verify that you'll get it. One last thing on the loan forgiveness. That's kind of the big federal government loan forgiveness. There are other types, especially with your state. So you can go on and kind of use Google, search out what your state has to offer. I know if you're in a medical field, just that's something that I work with a lot. It's very common for states. If you are in a service area where you get out of the city and you're working as a nurse or a doctor in a very rural area, you're helping them out because they need help in the rural areas. And so the states, a lot of them are doing loan forgiveness for rural area medical. That's just one that I'm very familiar with, but it's always worth something for you to go out and just see what's available to you. I definitely recommend double checking it. Even if you go to an advisor, they might not know your state specifically. I always try to search myself for people in their specific state, but I still ask them to help me look because they might spot something that I didn't. And if they think they qualify, then I help them look at it and make sure that we qualify for it. The last thing with student loans is the Parent Plus loans. Kind of the thing I really want to explain here is I've seen these all the time. A parent took them out, and I'm dealing with the young professional, the student themselves, but their parent took out a loan for them. And it's hopefully if you took them out, you had a long conversation of who's responsible for paying. The parent technically took them out, and so in the government's eyes, it's the parent responsibility to pay it off. In most scenarios, the parent has told you ahead of time that they expect you to pay it off. That is very, very common, and I'm dealing with that on a number of scenarios. And that might be one that, the student wants to get in their name. So if we refinance something, it might be the Parent Plus loan because they just act under a little bit different rules. Just something to keep it in mind if you have a Parent Plus loan or your parent does, that you've had those conversations and know who's responsible for paying, and that you're not, if it's your parent and you're paying for them, making sure that we're not destroying their credit, that you're getting theirs paid off. It's just some coordination, and it's very similar to that co-signer thing we talked about earlier. It's if you go that route, it's very much having those conversations and making sure that there's ability to pay there. Credit score, very briefly, I just wanted to talk about.
Before we move on, I'm sorry, we had a question about student loans. Can you talk a little bit about paying extra on student loans versus retirement?
Yep, we're getting there, and I will tell you, we did another webinar just last month on saving for retirement, and we discussed kind of saving for retirement versus paying on debt. Kind of the nuts and bolts of it are, if you're a young person and you're like early 30s and younger, retirement, you still have kind of the ability to get there eventually. And you still should be okay. I know every financial planner out there is telling you to get saving as early as possible. But in my mindset, it's all kind of comes back to your net worth a little bit. Your retirement accounts will give you a positive net worth, or giving you a negative net worth. As you pay off your loans, you're increasing your net worth because you're climbing out of that hole on that side. Some of the things that I said last time were, if you get a company match, I would recommend definitely getting your company match before you worry about putting extra towards your student loans, like at a minimum. You might put a little bit more. You might try to get up to at least 10% in your retirement accounts before you start worrying about, and that's 10% of your gross income, right? So it's your money plus whatever your employer's putting in. If you can get at least 10%, that's great. If you have to go down to just the match because you have such a debt obligation here, that's fine. You're still helping yourself out by getting the student loans paid off. What's really cool is if you get your student loans paid off early, all of a sudden now you have a stronger ability to save for retirement. Now you can put away, if you need to, 15, 20%, if you need to, because you've got the student loans, you made them go away. So it depends on your situation to really answer that, but that's kind of the nuts and bolts. And again, if you attend that other webinar, I think we go quite a bit more in depth.
And I want to say the other webinar is available on our YouTube channel and also on our website. You can look for recorded webinars on the homepage.
Okay, very briefly, I wanted to talk about credit score. Credit scores are important if you want to get a mortgage or take out debt. You want to have a high number. 750 is kind of that magic number where all of a sudden the whole world is open to you and being able to borrow. The factors that really go into that, very briefly. So payment history, as long as you're paying the minimum payment on all your debts religiously, your score is going to magically start coming up, because it's a very high factor. It's a very easy one to make sure you're doing. You want to make sure you're paying at a 90% or more rate. So 99%, 100%. You want to see that you're paying at least the minimum payment. That's part of why paying at least the minimum payment is so important. Young children just out of high school, they don't have debt yet. And so I see a lot of parents will take out a kind of student credit card within both of their names and start helping them build credit. And it's just kind of getting that payment history down, that you're making all of your payments. It's also helping out. I'm going to jump down to credit age. That can also help young people out. The average loan that they want to see is at least 7 years on your credit score, because then they know that you've got 7 years worth of solid payments going on. This one's not as important as making sure you're paying. It's more important if you have 3 years of payments that you've paid them all, versus I have 7 years of payments, but I didn't always pay. Utilization. So that's looking at like your credit cards and your line of credits, anything that your balance can jump up and down. It's saying keep that utilization below 30%. I would keep that as low as possible, especially credit cards are the kind of place you're going to see that the most. So what that's saying is if you can take out 5,000 on your credit card, you want to keep that as low as possible on average on how much you have on your credit card. If you're maxing your credit card out all the time, you have 100, like say it's completely maxed out, that's 100% utilization rate. If you're taking out half of your credit, that's a 50% utilization rate. A quarter of it's 25%. Not enough. The lower you can get that, the better. If you are hoping to qualify for a loan soon and your score is not perfect, what you can do is make interim payments on your credit card to keep it even lower. Don't wait to the end of the month to pay it in between, so that utilization stays a little bit lower. Just kind of a trick right before you go to get your mortgage to help keep your score a little bit higher. Derogatory marks. Anytime that you've totally failed to pay and they got to send you to a lien or collection agency, that's where this is going to show up. You want 0 marks of these. Another very common one are medical loans. I've seen medical places where you missed the payment, came in the mail, you didn't see it, so it didn't get paid, and then all of a sudden you got this mark on there. One's not the end of the world, but even if you feel like you don't pay it a lot of times, or feel like it was that you owed it or you got mad at the company, I assure you they don't care. They'll leave that judgment on there and it's only hurting you. So if you can get that paid off, you can try to negotiate and maybe get it knocked down. But trying to get those derogatory marks off of your credit report is very important. Those 3 are probably the 3 highest things when looking at your credit score. The last 2 here, total accounts, they're very low. They really don't matter a whole lot. Total accounts, the more accounts you have, the more different types of accounts you have. If you have a mortgage, an auto loan, and a credit card, that shows banks that you understand different types of debt if you're paying on them all. It just looks a little bit better. I don't think that's important. I don't have anywhere near 10 myself. I think we have 5 different small loans out or credit cards for various companies that we get the 5% back. You don't need 10. If you're somebody that gets in trouble with cards, I would highly recommend that you don't have 10. You would want as low as possible. Hard inquiries, that is where anybody looks at your score, that it's going to be an inquiry into your score. Those disappear after a little while. So if you see one on there, 2 is not a big deal. You might see those like utility company might check your credit score to make sure that you can pay them, or even the internet company, the cable company. Those aren't a big deal until you get a lot of them. So if you are somebody that's going to try to do some trick where you get huge benefits back on your credit cards and then you go take out like 5 credit cards right away, that's going to put up a bunch of red flags for all the companies, or at least the last ones. And so I just don't recommend it. But again, those aren't as big of a deal. And so definitely, if your score is really, really bad, you're struggling with debt, that might be a time to talk to somebody and get help figuring this out. I do have a kind of an asterisk down here when score doesn't matter. I get clients from time to time that are so concerned with their credit score, especially some of them close to retiring. And they really have no intention of ever borrowing again. And so it really doesn't matter at that point. If you're not going to borrow, your credit score really only matters if you're planning to borrow. It only matters, as you're trying to get up. If you get above 750, there's really no benefit to getting in the 800s outside of, yay, I'm in the 800s. It's really not overly important. I know I have talked with clients in the past where one spouse has a pretty good score, one spouse has a pretty bad score, and they were talking about, they might be talking about, we can do this, there's credit cards offering a one-time payment that's half of what I owe, and it can make it go away. But what that does is it puts a pretty big ding on your credit score. But if it's under just the one person's name and they've already got a bad score, then maybe you let that person take the hit, and the other spouse, their score is fine. So you let them continue to do fine. And then they can take out the mortgages when you need them. So there's some tricks there. Another one with spouses, really quick, a trick on this is if you have a spouse with a not as good credit score as you're freshly married and you both have cards, they have a worse score. You can add them as a signer on your credit card, and that gives them all this good history that you've built up on that card. You don't even have to give them a card, just add them as a co-signer and then cut their card up, and they're just on there and don't allow them to utilize it. I've seen parents use this with children. I've seen spouses do it. There can be a little bit of trust there if you're making sure that they don't get access to it if you don't want them to have access, but it's just one of those tricks that can help out. Paying off debt versus investing. I know we kind of answered that question, but both increase your net worth. I talked about that a little bit. Make sure you're getting your match. What's really cool, like I said, is if you get the debt eliminated, it frees up a lot of cash flow for you to save for retirement. So it's actually not a big deal. And then I think the last bullet points, just watch the other webinar. I think we talk about it in pretty good depth about what you should do in those scenarios. A couple other tips and tricks. Refinance for a lower interest rate. Like I said, if you have credit cards and they're getting you the 20%, I've seen this quite a bit actually, where somebody is a homeowner and they've already paid quite a bit of their home down. They, instead of 80%, they only owe 70%. You can get a home equity loan up to 90% typically. And so you can utilize that equity in your home to make the high 20% credit cards just go away. And now you have this home equity loan, and that's not ideal either. But the difference is you're probably getting charged 5% interest instead of 20%. So you're getting charged a quarter of what you were getting charged with the credit card. That's the difference of being underwater and feeling like you can't catch your breath to kind of getting that little life floaty vest, and then you still got to paddle to shore, but now it's very doable. I've talked about it quite a bit. Don't play games with credit cards. I know there's a lot of things that people try to do with the credit cards, but those, unless you make sure you're staying on top of it, can end up hurting you in the long run. Pay in full every month if you can. And this is a big one here. And this comes back to that last question of, should we save for retirement or should we pay on the debt? Paying on the debt is absolutely fine, especially with the higher interest rates. If you have an interest rate kind of 4% or under, that's not terribly bad debt. I might say, let's get up to at least 15% on your savings. But something that I've seen before, I've seen it quite a bit, and it's always really sad for me, as we focus on the debt instead of retirement. We fight really hard, we pay off the debt, and I think we're going to start saving on retirement, but by the time I meet with the client next, all of a sudden we've accumulated all this other debt. All of a sudden it's like, oh, we have cash flow and the bank's willing to lend to me again. And so we go buy a really nice car that we can't truly afford. We're not saving for retirement. And it really pains me because all of a sudden we're in our 50s and we still haven't saved enough for retirement because we just keep taking out new debts. And that's really not a place you want to get to. So if you pay off a debt, try not to replace it with another debt right away. Try to keep it gone. That's not something. If you pay off student loans and then you want to borrow for a house, I think that's perfectly fine. I'm just saying, don't pay off a credit card. Go ahead and then put a balance on the credit card right away. That's not ideal.
We did have a question that has to do kind of like that. Can you talk about leveraging debt? For example, if I own a residence and I have, say, 300K equity in it, can I leverage my debt or use cash out refinance to acquire a new home? Should you leverage your debt to acquire more debt? Conditions being cash flow positive.
I believe that's probably fine. As long as you can afford the new loan, right? If you're taking out a bigger loan and a new mortgage, it's just going to come back to, can you afford the new loan, the new mortgage? Can you afford all the debts? If you said cash flow positive, so I'm assuming that you've done the math, you can afford it. So I think that's okay. It's very common I think it's very common as you buy your first house, it's a much cheaper house. And eventually you want to upgrade. And so you're buying a bigger house, you got to take out a bigger mortgage. You can't afford the bigger mortgage. So you're doing that cash out refinance. And I don't think that's a big problem. I've actually even seen tips and tricks where, family gets their kids and they want to have a house with a pool. Well, we look at the math and they can't afford the house with the pool forever, right? It's too big of a house. If we're spending, that could be $750,000 on a house, right? Their old house was only half of that. It was a $400,000 house. If we're trying to do that, you might not be able to afford it forever. So you just have to understand you might need to downgrade someday, and it might work. And I do want to also caution against planning on downgrading. Usually what I see is we're downgrading to a bigger house. And so usually what happens is you might be downgrading in space, but you're actually spending more in the house. I've seen that time and time again with my retirees at my prior firm, that it seemed they never were spending less money, but I did see it. If you plan on paying and having that pool house while your kids are young, and then once they graduate and move off to college, then you're okay downgrading and having less space in a much cheaper house. Look at your financial plan again. It's just one of those tricks that it might make your financial plan work. You might be able to afford that pool house for a few years. And if a pool house is nowhere in the vicinity of things you can afford, I'm sorry for using that example. Just trying to get a few examples for anybody and everybody here. I have seen it.
Thank you so much. We have gone over time, and I want to thank Kate for staying extra to explain all these great things. And so we won't have any more time for questions, but during this outro time, if you do have some questions, go ahead and leave your phone number in the chat so that we can have someone reach out to you after the presentation. So on behalf of Advice Chaser, thank you so much, Kate, for being here again. We look forward to our next one, which will be understanding risk. And can you talk a little bit about risk as far as what we're going to talk about? We're not going to be talking about like mountain climbing.
We could. I would enjoy it. I just climbed Angels Landing at Zion this last weekend. Again, thank you everybody for coming, and I'm sorry for going over risk next week. It's going to be a little bit about.
It's going to be
or next month. I'm sorry. It may be a little bit about insurance and things that we can cover with insurance, but it's just going to be risk in general to your financial plan. Anything, we put together this really cool plan. Where are the common risks that we see to the plan not working? So that's, I think, something very important, that it's not the exciting piece of the financial plan. My young professionals, nobody's excited to talk about retirement. Nobody's excited to talk about the risks of the plan. We want to talk about the mountain climbing and things. And that's always my focus with my meetings, is talking about the things we really want to be doing. My job as a financial planner is to make sure we don't ignore the risk. We don't ignore the things that we have to do. but the bulk of my meeting time is usually talking about mountain climbing if that's what they enjoy, or sailing if that's what they enjoy.
Well, that certainly, if
it's a
you
little bit of
manage your
everything.
risk, you have more latitude to do those things.
Yeah.
Well, thank you everyone for attending.
Thank you.
Thank you. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for attending, and we will see you at another webinar soon. Bye, everyone.